In this video, we're going to talk about Medicare supplements, also called Medigap plans. It means the same thing, it's just a matter of which term you prefer. So what are Medicare supplement plans? Essentially, they are private health insurance plans meant to plug the holes that original Medicare leaves you financially responsible for. So the way to think about this, original Medicare is Part A and Part B, the combination thereof. It's great coverage, gives you ultimate flexibility in where you get health coverage, no networks, no prior authorizations, but that doesn't mean it's free. You participate in the share of costs. So it's the access and the costs. And original Medicare on its own leaves you liable for a fair amount of costs, even though you can get coverage, right? So Part B, for example, you're paying a deductible of $240, which is very low, but then you're on the hook for 20% coinsurance for everything after that, and there is no limit on that. So as you can imagine, with the expense of healthcare these days, that can rack up pretty quickly. And you also have deductibles and coinsurance for a hospital stay as well. So most people want to do something about that, and most people should do something about that. So a Medicare supplement is the option to keep all the good things about original Medicare, which is unmatched with any other health insurance in this country, but putting a limit on your financial exposure. So you can, in most cases, get your financial exposure down to you're just paying that Part B deductible of $240, and that's all you're paying for medical care for the year. Prescription drugs is in another bucket, but for medical care, the big stuff, the stuff that can get really expensive, you are in really good shape with a Medicare supplement plan. And a lot of people really like the comfort of knowing that their cost exposure is very, very low, and they're willing to pay the premium for that. It's the more expensive of the two Medicare coverage routes, the other one being Medicare Advantage, but you get what you pay for. So let's talk about Medicare supplements and how they work. So basically, they ride the coattails of Medicare Part A and Part B. So what I mean by that is, let's say you go to a doctor, you get a service, a visit, a test, a screening, whatever, a surgery even. If Medicare pays for the claim, then the Medicare supplement has to pay as well. So there's no decision by the insurance company to say, maybe we will or won't pay this claim, or hey, we want to take a look before you go get that surgery or whatever. If Medicare pays for something, the supplement has to pay for it, and they have to pay per the plan specifications that Medicare set. So that's a good thing, because an insurance company isn't going to have to muddle with your health care, which, if we can have that, that's ideal. So what are the different types of Medicare supplements? There is Plan F, Plan G, Plan N. Those are the most talked about. Plan G and Plan N are really the only relevant ones these days. Plan F is no longer available to people who are new to Medicare, so I'm not going to talk about that. So let's talk about Plan G and Plan N, not to be confused with Part A, Part B. It's Plan G and Plan N. I know it's confusing. I didn't make this stuff up. But Plan G is the most comprehensive Medicare supplement you can get. Plan N is close. It's just got a bit fewer benefits, but it's less expensive in exchange. So Plan G is going to set you up where you are only paying your Medicare Part B deductible of $240 a year. That's what it is in 2024 anyway. It goes up a few bucks every year, but a couple $100 a year is your maximum out-of-pocket cost exposure for medical care for a given year. It's fantastic. Everything other than that, the plan picks up. Plan N it works much the same, but there are two key differences. The first is it's going to introduce copays. So up to a $20 copay for a doctor's office visit, up to $50 for an emergency room visit that doesn't lead to you being admitted to the hospital. So just ER in and out. Doesn't mean you're going to have to pay those copays, but if you do, and if you go with Plan N, I would just set that expectation that you would pay it. It's going to be only up to $20 for that office visit, only up to $50 for the emergency room visit. Not a big deal. The other key difference with Plan N is it doesn't cover something called Medicare Part B excess charges. So basically all this means is when a doctor accepts Medicare, there's an agreed upon price that Medicare will pay them for rendering a service to you. There's this big old list of any possible service with a price attached to it, and the doctor has to agree to be paid only that amount by Medicare if they accept Medicare. There's an exception. Let's say for any given service, they say, that agreed upon amount Medicare, that's not quite enough. I need a little bit more for that. They can charge, and I'm not going to get too deep into the specifics, but generally speaking, they can charge up to 15% more than that agreed upon Medicare amount. It's called the Medicare assignment amount for that service. And with Plan N, you would be responsible for that extra 15%. So it's a rare case that you'd have a Medicare Part B excess charge. I believe it's anywhere from 2 to 3% of all Part B claims have an excess charge attached to it, but something to keep in mind, something you would be responsible for. Now, why would you choose Plan N over Plan G? Well, the obvious answer is price. Plan N runs about, depending on where you live and your age and all that, about 20% less per month for the plan itself than Plan G. Another reason you might want to choose Plan N over Plan G is not only the rate today, but the rate tomorrow. So everything, gas, food, and certainly health insurance goes up every year. A normal rate increase for a Medicare supplement is anywhere from 2 to 5, 6, 7%. In some cases, you'll have larger increases, but you want to aim for a company that has a rate increase history that's steady. You're going to get them, you can't avoid them, but let's go with a company that is not going to just have erratic rate increases, right? So within that, we need to consider, okay, put your hat on, or put some goggles on as if you're an insurance company. Very exciting, I know. But if you're an insurance company, you're in the business of making a little bit of profit, right? And so if you've got a bunch of people with a Plan G, for example, who are just shopping spree, any question about my health, let me go to the ER, let me go get this procedure, let me just do all this, do all that, the expenses of that person's health care rack up, and the insurance company is going to lose money. Or it's more expensive anyway for the insurance company to insure that person. You get enough people doing that, then the insurance company, they don't do this for charity, they're going to raise the rates in response to that. So Plan G is pretty much do what you want, just pay the first $240, the rest you're good. Plan N, it adds a couple of speed bumps, those co-pays and the Part B excess charges. You as the person with the policy, you have an incentive to be a little more careful about when and where and how much health care you get. You're still entitled to it, but you participate a little bit in the cost, and it might make you think, hey, maybe I don't need to go to the ER. Maybe I'll go to like an urgent care. This isn't that big of an issue. That's going to save the insurance company money, and so they're not going to be as incentivized or as moved to raise rates. So you do that for years and years, and then Plan N, we've seen historically, the rate increases for Plan N have been lower. Sometimes they are flat year to year. Not going to say that will be the case forever, but just thinking about it from a math perspective, that makes sense, right? Plan G is more expensive for an insurance company to insure versus Plan N, so the rate increases are going to be a little bit higher with Plan G. Not egregiously so. It's still worth considering Plan G if you're just the type of person who says, give me the best I can get, and there's nothing wrong with that. So those are the differences between the types of Medicare supplements you can choose. Now let's talk about the differences between companies. That's another very valid question. Usually with anything, there's a little bit of competition and some differences in what you get for what you pay for. Not with Medicare supplements. There is competition, but it's a unique product in that it is a commodity, right? So Medicare, like I mentioned before, Medicare sets out the plan specifications for Medicare supplements, which means if a company sells a Medicare supplement, they have to adhere to those plan specifications. They cannot deviate. So in effect, that means Cigna's Medicare supplement Plan G is the exact same product as Mutual of Omaha's Plan G Medicare supplement, just for example. They sell the exact same thing. So the difference is, and remember to add to that, if Medicare pays a claim, the supplement has to pay in accordance with Medicare to the plan specification. There's not going to be a difference in what company treats claims this way or another, which is good for you, the consumer. So really what you're doing is you're shopping based on price, and there will be differences there because companies do have different business objectives. Maybe a company is moving into a market and they really want to win market share. So they're going to get aggressive with their pricing and incentivize people to choose them over a competitor. Take advantage of that. The flip side of that would be a company has been in a market and they are losing a little more money than they want to, or they want to kind of throttle how much risk they have. So they're going to raise rates to disincentivize people to sign up because, believe it or not, there is a limit to how much risk or how much business an insurance company might want in some cases. The other thing to keep in mind is, so let's choose a company that has an aggressive price or a competitive price anyway. But let's limit the companies we're going to choose from to the ones that have been in this market a while. We've got some rate increase history. We've seen how they act year to year. So we're not going to be surprised by like a 20% rate increase. We want a name that we would recognize, most likely. There's some names that you wouldn't recognize that are really big players in the market that are very strong. But for the most part, blue chip names, with good histories, right? It's just kind of common sense. You don't want a fly-by-night company with this stuff just to get a cheap rate, because in a year or two from now, that rate increase you're going to get from them is probably going to be astronomical. So that's how to think about how to choose. Get the best price among the most reputable companies with steady rate increases in your area. And all that data is out there. And brokers like me have access to pretty detailed info there and can give you guidance that way. Let's see, what else to cover with Medicare supplements. When to choose one and kind of how to think about choosing Plan G, Plan N, which company. One last thing to think about. You get, with a few exceptions, and I wouldn't count on ever having one of these exceptions, but when you first enroll in Medicare, that is your one shot to buy one of these Medicare supplement plans without having to answer health questions. So it's guaranteed issue. That's the industry term, which is good. You can choose any plan you want from any company you want when you turn 65 or you otherwise enroll in Medicare after that for the first time. And beyond that, you can change plans if you'd like. Let's say you get a rate increase that is a little bit egregious and you shop the market and, hey, there's a competitor who's moved in with a lower rate. Let me go hop over to that. You can do that, but you have to answer underwriting questions, health questions. And it's not guaranteed a company would accept you. If you're in generally good health, then you're not going to have a problem, but we can't count on that, right? So my advice for clients is buy a plan now as if it is the only shot you have. Don't even pretend that you might have the option to switch it down the road. If you do down the road, great, let's do it. But don't act in the first place like that would be possible. Just keep it safe. All right, so we want to choose between Plan G and Plan N on that basis, and then we want to choose the company on that basis. We don't want to go, again, with a company with huge rate increases. So that's how to choose one. Last thing I'll mention, because this is a common question, how to buy these. They're not as easy to buy as, say, a Medicare Advantage or Medicare Part D plan. You can certainly call up a company that sells them, and then they will sell you with an in-house agent. They'll sell you the plan, but you can't do like a self-enrollment thing, at least as of this recording. That's because they're kind of complex products. So the best way to go about it, I'm a little biased here, is to use an independent broker who works with several companies and has like an open view of the market and can compare them, on an even playing field. And then, hey, if this happens to be the right company and the right plan for you, let's go with that. Or if that one over there is, then let's go with that. I don't care. And so you don't pay anything extra by using a broker. You don't save any money by going directly to the insurance company. The way an agent or broker gets paid is by a commission. It's usually about 20%, per month, usually, or throughout the course of the year. It's all the same. And what that money comes from their marketing budget, the insurance company's marketing budget. So let's say you did go straight to the insurance company to buy one of these. Then they would probably assign the marketing costs for that to have earned the business. They'd chalk it up against their advertising or marketing or to their in-house agent, something like that. If an independent broker brings the business to them, because you shopped with an independent broker, then they are essentially, the broker is like their marketing expense. So they just take those dollars, assign them to the agent who sold it versus internal expenses for marketing. So that is an overview of Medicare supplements. Relatively quick and dirty, kind of all over the place, but that is how I explain it to someone if you had called me up and just say, hey, give me your Medicare supplement 101. That's it. Hope this has been helpful. See you in the next video.